Hello, and welcome back to another episode of Crypto My God. We're going to get a little bit technical today because there's been a lot of beef floating around the Ethereum ecosystem. And I want to tap into a little bit of that because I'm sure everyone on the trading side, on the buying side, is looking at the ETH versus Solana debate. And it's just like, man, ETH is in the shitter. What is going on there? Obviously, Solana has been doing fantastic around memes, around a lot of its high throughput transactions, but the conversations around ETH are really revolving around the L2 ecosystem, right? The Ethereum base layer is now seeing competitive little layers on top. They're called L2s that are vying for the profits and for the margins and for the fees. And what does this all mean? Let's dive into it. So this is a conversation that's really been going on for the better part of the last year. And this post from Zach at Chainlink God really encompasses it quite nicely, which is that something is happening in Ethereum land where the L2s are being attacked and attacking each other for not being efficiently ETH aligned. Now, this is a concept that is beginning to pick up steam. The thing with Ethereum is it built this amazing base layer for decentralized security, especially when talking about financial assets. Now, the real issue is that these L2s are the ones now ordering a lot of the blocks, really putting the transactions in place. That gives them opportunity to do something called MEV, minor extracted value, minimally extracted value. This is basically looking at the order blocks and arranging them in such a way that you create a little bit more value yourself that you can capture. And the thing with the L2s is they are all now sequencing these transactions. So they are taking on the role of MEV capture of some of the gas fees in the competitive marketplaces that exist on Ethereum. And of course, they are competing with each other. So unlike Solana, which is this monolithic blockchain in which everything that happens on Solana is exchangeable with Solana, and it's just kind of a one and done, set it and forget it. Ethereum is Ethereum, and then a variety of L2s. These L2s would all like to become the L2, and they have different offerings, they have different outcomes, and of course some of them, like Base Chain, is under the subsidiary of Coinbase itself. So this all becomes really interesting. He goes on to say, obviously there's clear and widely recognized concerns about ETH's value accrual and demand, notably after the network revenue fell off a cliff after blobs were introduced in early 2020. The root problem is that Ethereum forfeited the most valuable part of the tech stack, MEV and congestion gas pricing, to the L2 networks, while keeping the least valuable part of the stack, the settlement and the data availability. Right. And this is what it goes on to say, which is that the value capture of the blockchains is not actually in the secure settlement, right? There is a virtual machine that is securing all of these blocks. Once they're minted, it stores it into a data availability layer, right? So we're looking at, you have a list of transactions. We say that these are confirmed and they get stored into a little cabinet. This is called data availability. Later on, anybody wants to confirm a transaction, they can look back at the history in the DA layer, the data availability, and they can pull those transactions out and say, yeah, that's true, right? Or they can reject it, say this transaction can't work. Now, both data availability and the settlement are extremely important for the security of the chain. But is that where fees are going? And it's not, looking like not quite. Fees are really in the ordering of the transactions and these gas fee markets, which is basically saying, hey, if you want to speed up your transaction and get it through faster, you have to pay higher gas. They control that market on the L2, which means less of that is now going to Ethereum. This used to happen on the Ethereum L1, and if you remember, gas prices went up really high, but they introduced this concept of blobs in order to support L2s so that they could take all of that activity off of the Ethereum layer. Now, a blob you can think of as a large chunk of data that is full of transactions, and that can be referenced on the Ethereum layer 1. They are not actually, you're not taking the entire transaction history and putting it there. You're basically just making a hash and storing all of those transactions into a data availability layer, and they expire after, I can't remember, 30 days, something like that. So basically saying that the transaction history doesn't need to stick around forever. One of the key problems was that as Ethereum kept growing, all of the node operators had to keep downloading every transaction. And at some point, the transaction history just grew and grew and grew. So they created this blob idea to say we can take those transactions, we can put them aside, and at some point we can call them quits. We don't need to store this data forever. This allows it to scale, to allow for more transactions, to allow for a longer thread of history, and to be able to secure that through at-home node operators, which is really Ethereum's crowning achievement, that anyone can support the network from the comfort of their own homes. It doesn't take a big data center. It's not really expensive. So, of course, we go back here and we see the revenue cost to profit, and profit being this trend line here. And of course, L2 revenue versus L1 blob fees. This is what we're really looking at. The L1 blob fee is a fee from the L2s being paid to post their transaction history to the L1. Those fees are pretty minuscule, whereas the L2 revenue is quite high, as we see here. So this has all really been going back and forth. And this comes back to the EIP 4844. And this is the beginning of the blobs, the introduction of blobs. This name is a truncation of two ETH developers who came up with this protocol. And basically, it allowed for the updating of these blobs. So previously, the chain was keeping records of every transaction that ever happened. And they said, no, we're going to allow these L2s to make their own transactions to create these blobs, and they can print that to the L1 itself. Now, the beef started kicking off earlier this week with a couple of tweets from Sonic. Now, Sonic is an L2 on the Ethereum network that comes from Andre Kronja, a developer that is very famous for just kind of pushing the code to production and saying, hey, we're going to figure out the bugs when it's live. You know, throw money in early if you want. And he's actually one of the major brains behind a lot of DeFi developments over the last cycle. So he's very emblematic of the punk nature of Ethereum, and he recently launched an update to the Phantom blockchain, which is now called Sonic. It's very fast, it's very cheap. He's even offering the Sonic updates to the Ethereum L1, saying take the tech, you know, it's out there. And one interesting thing about Sonic is it doesn't have venture-backed money. This is all really organic. This is just kind of being posted to the internet, and it's really exciting. Now, the assistant who works for Sonic started calling out Base Chain, saying that there is a 90% profit margin, around $100 million, on the Base L2 sequencer. The sequencer is what orders the transactions. 100% of that ETH was sent from Base to Ethereum to Coinbase Exchange. This is a fact. See it for yourself. And I will give you this in the description of this video. This, of course, kicks off a storm, and Jesse, who is the head of Base Chain, Jesse Pollack, says, I have some thoughts over the weekend. Purity tests like, do you hold all the ETH you earn, are a distraction, and they hurt Ethereum. Now, this is all very reasonable, right? There are some major businesses being built here. And of course, businesses need to make profit. They need to pay their employees, and they need to figure it out. However, if we're looking on chain and we see that value just being extracted and sold, much like Pump.Fund does on a Solana, people start to question, you know, how aligned are we on our core goals? If you're mostly accruing ETH and dumping it, how can anyone that holds ETH expect this price to go up? This is why we're seeing a dampening. This is why we're seeing the asset just basically be flat. So this starts off a whole back and forth, and they begin to fight. And really, this opens up a conversation to the broader Ethereum community. Where are the core values being held? Obviously, the decentralization is foundational to Ethereum itself. But if ETH is not going up in value, if the bag holders are not getting rewarded, how can we continue to support this asset? There's just going to be a natural movement via market forces to other technologies. Now, one thing to note is that Ethereum put to use is still full of revenue generating potential. So inside of DeFi ecosystems, inside of proof of stake conceptualities, there is opportunities to make capital. However, to buy and hold ETH or just to purely stake it has not been good returns, and people are starting to get annoyed. I mean, this is pretty straightforward. So there's a lot of concern here. You know, Jesse is saying that if we make money and we spend it on growth, and at the same time we give back to Ethereum, is this not something to be celebrated? And they are beginning to post their statements, and you know, people begin to chime in here. And I think there's a lot of different takes on both sides of the aisle. Now, what I want to just look at here is just a little bit into the blobs, right? We have some really amazing data, and we can begin to look at how is financial reward and mechanics being moved around inside the Ethereum ecosystem. So we start with the rollups. And L2s do come in a variety of ways. There's a rollup, which basically rolls up a ton of transactions. Validiums and optimiums, which are just, again, different ways of coming to the conclusion of settlement. And of course, others. So I'm going to live mostly in the rollups because they are the fastest to deploy right now, and they're also the big winners in the space. Optimistic rollup means that they're assuming that the transactions are good and that they will retroactively look at negative transactions. This just allows things to scale faster, to be easier. So we have these things going on. Arbitrum 1 at the top, base chain, OP mainnet. Now, base is built on OP mainnet. However, it's a fork, so all pretty interesting there. You can see how the technology is beginning to overlap. And they have a lot of value, right? Total value secured is $14 billion on Arbitrum. So that's pretty amazing stuff. And now as I go over to the economics, we can see that there's a cost to publishing transactions to the L1. And that's been going down quite aggressively. So for all the value being captured, we can see the cost to publish batches to L1 is increasingly moving towards zero. This is very bullish for scalability, but again, not so great for price accrual, right? The L1 is able to now handle lots of transactions for a low fee. Great for building apps, great for utility, not great for getting paid, right? The L1 itself is not seeing a lot of that Ethereum. Now, then we get to, I think, the core, which is revenue on L2 transaction fees. And let's move this over a little bit. I'm getting kind of cut off. But what do we have here? We have the dark blue, which is base. It's a great tool, and I love using Dune for this feature. You can see that a lot of value accrual on Ethereum right now is actually going to the base chain directly. Kyle Samani of Multicoin Ventures is known for just tweeting the future of Ethereum is base. And it's hard to argue with him when you look at the way that these revenues are going. Let's try to find Arbitrum. There you go. So Arbitrum also seeing a lot of revenue coming out. And of course, OP mainnet, one of the majors in the stack, but it's pretty egregious when we look at base itself. You can see where the majority of transaction volume is coming. And this is coming from fees that users are paying to make a transaction, as well as the competitive gas market, which is, again, determining what those fees cost. And then last but not least, ordering the blocks and putting the transactions in a way that actually allows for more value to be created. You can squeeze out and juice that lemon when you control the block formation. So this is all very alarming. Again, if we see that all of the revenue being captured here on base chain, it's quite significant, right? This is in terms of 20 million clips here. So 0 to 20, 20 to 40, quite significant. And of course, we saw that the cost of submitting blobs on ETH is in a decline. So you do see that the value creation is going very firmly to these L2s. And one thing to really keep in mind, L2 to L2 cross functionality isn't really a strong thing yet. There are some bridges. There's a variety of takes on how they move between the two. But if you want to move a stablecoin like a USDC from Arbitrum to Optimism, which is also base, it's difficult. It is not easy. It's a pain in the ass. It involves gas spends and a ton of clicks. So it's not really a very positive experience versus Solana, where everything is composable due to the monolithic base layer, and any app can transact with any app as long as it's built on Solana. So all of this is to say, the Ethereum community is having a lot of self-reflection at the moment, saying we really do love the core ethos of decentralization. We just need to figure out how the funding is working. There's a reason that ETH is not going anywhere, and it's creating a feedback loop. But of course, every time we see these barriers, we do get very interesting and creative answers to these problems. So all of this is to say we're not going to count ETH out. I mean, look, it's still doing amazing volume on transactions. Even if it's going to the L2s, this is still happening on the Ethereum blockchain itself. While we're scaling, while we're finding out what the killer app is, I mean, does it exist on just one of the L2s when it does launch? Will the L2s become very fluid? Will you not even know what you're moving between? Frankly speaking, we're moving towards AI-operated wallets, where most of these transactions are going to happen through a voice command or a text prompt or something more natural to the user interface. And how is that going to impact the value capture, the value creation, the value generation on these chains? So this is a really fun thing to follow. I will continue to post more in depth. I just wanted to explain sort of the top level situation with the blobs, why Ethereum value capture is kind of getting stuck at the top and is having a trickle down economics effect, right? We're not seeing the impact of the trickle. And it's something to think about as you consider where you want to store your value, what operating system you'd like to function inside of. And as always, guys, if you have any further questions, please put them in the comments. I'll continue to stay on top of this topic, and I hope that you learned something, and good luck out there.